My name is Alexander Treves. I am an investment specialist for the Emerging Market and Asia Pacific Equity Team based in Singapore, and I'm delighted to be speaking to you about the Chinese equity market and our fund's performance in that space. The performance has been challenging across a number of different sectors amid the style rotation favouring value over growth, to some extent at the sector allocation level and at the level of stock selection. We've stayed true to our philosophy and process, focusing on growth with a quality tilt. The first performance challenge has been persistent style headwind over the past 3 years, impacting our strategy's performance given our tilt towards quality and growth. Value cyclical stocks outperformed for the past 3 years, while growth continued to derate amid the headwinds from rising rate environment globally, a lack of consumer confidence, and the property downturn in China, which led to a prevailing risk-off sentiment. As a result, the market favoured defensive state-owned enterprises with generally a lack of profitable mindsets. Our strategy typically don't own those. Our underweight in financials, structurally we're underweight the state-owned enterprise banks, mostly detracted. The largest Chinese banks tend not to offer attractive earnings growth and are particularly at risk of being used as instruments of government policy. In other words, they have less focus on profitability. However, high investor risk aversion favoured SOEs, making them defensive in a China context. Our underweight in energy lagged. Energy stocks outperformed given the strong energy price, and partly because, in a risk-off environment, investors tended to favour SOEs or state-owned enterprises which they thought offered less risk. This does not fit our growth and quality approach. Sector allocation disappointed, for example, consumer and reopening sensitive stocks. Consumer, healthcare, and reopening sensitive stocks suffered from underperformance. At the start of 2023, we had a positive view that reopening would stimulate consumption, so we added to cyclical growth opportunities, for example, Chinese liquor, budget airlines, and consumer-sensitive businesses. But some of these sizable positions, mostly in consumer names and healthcare, didn't play out as expected. The confidence rebound disappointed due to the scarring effect of COVID on consumer confidence, and the weakness in the property and job markets, resulting in household spending caution. Within healthcare, IMEC, a medical aesthetics leader, was the biggest detractor as cosmetic injectables are a big-ticket item and discretionary in nature, thus experiencing worse than expected momentum. Renewables and industrials. We remain strong believers in China's energy transformation, but EV, electric vehicle, end demand is still discretionary and has been slow to recover. Despite strong EV volume growth, we've seen an intensification of EV price competition, which led to weaker pricing and impacted margins along the supply chain. The electric vehicle-related semiconductor producer Star Power Semiconductor was the major detractor in 2023, as the weak consumption environment has impacted its business supplying to EVs. Stock selection, for example hardware, somewhat detracted from gains despite long-term growth potential. The Chinese equity market offers quite a wide choice of AI, artificial intelligence, beneficiaries. Foxconn Industrial was among the major detractors in 2023. It is the sole server ODM for NVIDIA, with very strong positioning and visibility of earnings growth for the next 2 to 3 years. It is one of very few tech companies with a global supply chain, so is not much impacted by the US-China tensions. However, its ex-boss ran for president of Taiwan, at which point the Chinese authorities started investigating Honhai in China. The company trades as Honhai Technology in China and Taiwan and as Foxconn internationally, impacting its share price. Performance contributors. Stock selection in the communication services sector was a positive contributor to returns. NetEase had a positive contribution. While NetEase had a volatile end to 2023 on the back of regulatory concerns, it generally performed well in 2023 as its results exceeded expectations. Tencent also delivered gains. We believe that the monetization for video accounts would help the company to regain share in the online ad market. Tencent should also benefit from growth for games, fintech and cloud, as well as margin expansion given its leaner cost structure. Pinduoduo was the biggest contributor. This value e-commerce player has benefited from exponential growth in its international e-commerce arm, Temu. Stock selection in a few artificial intelligence beneficiary names outperformed. Beijing Kingsoft Office contributed the most. The company has a long growth runway and a strong ability to monetize their business. The company benefited from the AI-related excitement. Our exposure to growth has remained largely unchanged at the overall level as we stayed true to our philosophy and investment process. We are overweight IT, information technology, consumer staples, industrials, healthcare, while we are underweight financials, materials, energy, and utilities. That said, compared to 2 years ago, we brought a number of portfolio adjustments, for example, reducing the number of portfolio holdings, concentrating our bets, and rotating a few names within these sectors. We aim mostly, first, to reinforce the risk control in the portfolio, and second, to look for idiosyncratic growth opportunities which are less sensitive to macro cycles. For example, in IT, we added to AI beneficiaries such as Foxconn Industrial, Zhongji Innolight, whilst reducing names whose valuations are not supported by their weaker earnings momentum. In a very consolidated industry, Innolight is one of the best quality Chinese exposures to global AI demand. In electric vehicles and industrials, the challenges faced by the EV market notwithstanding, the battery supply chain is showing signs of recovery from its trough. So we topped up our exposure in CATL. Within industrials, we concentrated our bets adding names like Zhuzhou CRRC Times Electric, and Seoul names with weaker outlook like Suzhou Maxwell, which has had a slower than expected technology adoption. In solar, we concentrated our positions within the solar space by buying the polysilicon maker Tongwei, given tighter supply and demand dynamics in polysilicon. Consumer and healthcare. We've continued to moderate some consumer and a few healthcare exposure, particularly names which have richer valuations and are more vulnerable to earnings disappointments. We concentrated our bets on selective internet, for example, Pinduoduo and Baidu, travel, Trip.com and Hworld, and consumer staples names such as Kuiqiao Maotai. Conversely, we trimmed Meituan and exited some consumer staples. We rotated within healthcare, reducing Wuxi Biologics on geopolitical risk, and buying Sinopharm. We exited Aya Eye Hospital amid its anti-corruption campaign. In financials, we rotated towards names such as Hong Kong Exchange and CITIC Securities for portfolio risk control, as they should benefit from cyclical recovery whilst being at lower risk of national service. We diversified our insurance exposure with China Pacific Insurance. Real estate. We rotated within our property management exposure and trimmed our existing holdings amid slow consumption recovery and the continued property market weakness in China. Materials. While staying underweight, we pivoted towards selective EV-related opportunities, Sunres in new materials, Gangfeng Lithium, for example, whilst exiting SK SHU Paint amid property weakness. China real GDP was up 5.3% year-on-year and 1.6% quarter-on-quarter in the first quarter of 2024, reflecting sustained recovery in activity. It's noteworthy that the recovery is biased on the supply side with stronger growth in the manufacturing sectors, while challenges remain in consumer sentiment and real estate market. On the supply side, industrial production increased by 4.5% year-on-year in March, featuring booming output in automobile and technology products. On the demand side, the cautious sentiment affected households' financial decisions. Household savings increased by 11.8% during the past 12 months. Against this backdrop, developers are subject to mounting pressures from slowing property sales and lower sales prices. The weakness in the property market then affected household consumption via the wealth effect and local governments through fewer fiscal revenues from land sales. The steady drumbeat of small Chinese stimulus announcements continued, and cumulatively they may be starting to have an impact. Although policy measures have been incremental, they've also been wide-ranging, covering fiscal, monetary, housing, capital markets, and FX areas. The focus is not on directly stimulating demand, but rather on eliminating tail risk. We believe that cumulatively, these policies are starting to have a positive impact, although it is important the momentum is maintained. On China real estate, we should continue to see incremental stimulus policies whose aim is to eliminate tail risk. This should help alleviate financial stress as the real estate sector causes pressure on the local banks in particular. We believe the real estate policies will help unlock upgrading demand, as eligible home buyers can now enjoy both lower down payments and more attractive mortgage rates. Overall, we believe that China's macro picture is now shifting more towards growth. With the tailwind of government policies which are more focused on restoring industry and consumer confidence, we see some positive signs. The economy's ability to produce more output is not the major challenge. Rather, it's the ability of domestic and global demand to absorb that output. With the pickup in export orders and the impact of domestic policy support in recent months, we believe there may be better near-term momentum in economic activity as the year unfolds. In that context, we expect neither meaningful monetary stimulus nor direct fiscal transfers to households. The priority in that respect is to address local government debt, which is resulting in some austerity in that direction. Key risks include domestic factors, for example, ongoing property market weakness, and external factors such as geopolitical risks, the trajectory of the US dollar, and a global slowdown which may impact earnings in Asia and China if it takes place. Our long-term portfolio positioning remains consistent with overweights in technology, for example AI proxies, and renewable energy, for example solar and the EV supply chain. We've added to stocks which offer an attractive risk-reward trade-off and the prospect of a near-term cyclical turnaround as the macro environment improves. All in all, we stay true to our philosophy, with a focus on growth with a quality tilt. We retain our conviction in structural growth opportunities, for example technology, carbon neutrality, and consumption. We should not confuse the market outlook with the economic outlook. Taking the Japan example, the economic growth in Japan has been slow, but growth has outperformed value stocks for the last decade. In recent years, value has started to outperform growth when economic growth improved. Therefore, we would be cautious on drawing the correlation between GDP growth and investment style outperformance. Besides, corporate earnings in China now look better than in mid-2023, partly due to cost tailwinds. A number of sectors such as the IT segment, for example semiconductors and hardware, are seeing earnings upgrades. The industry structure in China remains immature and the authorities' pro-business policy will help support the long-term growth story. Many industries with the best players are still borderline in terms of profitability. Given the scale of the economy, many companies remain very compelling. There are still lots of capacity for growth companies to perform well in our view. Besides, the Chinese authorities' stimulus policy will help support the structural growth story in China. We believe the policy highlights are mostly in the following areas. First, policy focus. AI and digitalization is identified as new quality forces. Machinery and appliances as potential beneficiaries of the trade-in focus to drive upgrades and efficiency, and innovative drugs are receiving more support for their research, development, and commercialization. Second, addressing overcapacity. The CSRC and the PBOC promise to limit financing in overcapacity sectors to ease pricing pressure, with renewables and EVs as cyclical beneficiaries. The broad China universe provides good breadth and dispersion for active managers. Both China universes offer more breadth and better dispersion to arbitrage than the rest of the global emerging markets universe combined. In a market in which we see a lot of corporate capital chasing great ideas and potentially competing away returns, it is essential to manage bet sizing. Conversely, the value universe in China, with reasonable levels of quality, is very narrow at this point in time in our view. We question the alpha opportunities of these companies which pay reasonable yields. With valuations at historic lows, the downside from here is quite limited. China continues to face headwinds, but there is still an opportunity to create alpha, especially as a lot of this is already priced in. China is trading at 1.2 times price to book and 9.1 times PE ratios as at the end of the first quarter of 2024, its lowest level since the Asian financial crisis. Don't wait for obvious catalysts, or it may be too late. Once a catalyst is obvious, it is usually already reflected in equity markets. In past cycles, investors buying Chinese equities at current levels of price to book have typically enjoyed attractive subsequent two-year returns. Past corrections and subsequent bounces lead us to believe that the equity market recovery is likely to persist. We believe that the upward path for earnings will justify a higher ROE, which in turn could lead to an upward re-rating for price to book ratios, which makes a fertile ground for our active managers. A number of domestic champions or companies presenting strong earnings potential are currently trading at large discounts. For instance, our expected earnings growth for the Chinese provider of online entertainment video services, iQIYI, is double-digit, around 20%, given the growth potential within the business turnaround, while the company currently only trades at 9 times 12-month forward PE ratio as at the end of April. The company presents a strong balance sheet, generates lots of cash flow, and has a strengthening competitive position. We retain our long-term conviction in structural growth opportunities, although we monitor short-term developments closely. Technology. Driven by industry upgrades and import substitution, China offers a diversified range of opportunities in areas such as semiconductors, automation, and software. Government support, substantial investments in R&D, a burgeoning tech ecosystem, and a vast pool of skilled workforce helps drive these growth areas. A few Chinese companies are embedded into the supply chain for AI, such as manufacturers of optic modules or key components that go into AI data centers. Global AI servers are rapidly overtaking traditional servers and are expected to increase by about 14% CAGR by 2030, which should benefit these names exposed to the AI supply chain. For example, Beijing Kingsoft Office, which is the #1 Chinese provider of office software solutions. The company has a duopoly with Microsoft and already has the largest user base in China. The company's share price has done well because of excitement related to AI. Software is a beneficiary of the trend towards self-sufficiency as the government encourages the use of domestic systems, which in addition are specifically designed for Chinese usage. Carbon neutrality. China's national security priority to achieve carbon neutrality, evolving consumer preferences, and a drive towards energy independence is positive for new energy, including the global solar industry, technology enablers to help transform old China, and the EV supply chain. Within solar, China dominates solar manufacturing globally across the value chain. China is supported by strong government incentives and relatively low energy costs, facilitating the growth of the polysilicon industry. 85% of global polysilicon capacity comes from China. Within EV, China has the most comprehensive EV supply chain in the world, from lithium and cobalt all the way downstream to the EV brands. New energy vehicle penetration is expected to reach 90% in China by 2030, versus around 30% currently. For example, CATL is the top global EV battery supplier in China, with nearly 50% market share. Global contract wins include current and future orders from customers such as BMW, Daimler, and Honda. EV penetration is low but rising, which means that CATL has a large share of a rapidly growing pie. The company enjoys barrier to entry due to experience in the industry. Consumption. This sector offers many opportunities, from the ability to upgrade as consumers become wealthier, to high-tech medical products and services in areas of the market with lower regulatory risk. With increasing online penetration, services e-commerce such as food delivery has a long growth runway. For instance, food delivery as a percentage of total food consumption is expected to triple between 2018 and 2025, reaching over 15%. For example, JD Health is one of the largest self-operated online pharmacies in China. The company has a strong competitive edge, including free and high-quality user traffic from its parent JD Group and a well-established offline infrastructure. JD Health benefits from the rising e-commerce penetration in major healthcare product categories. We do not arbitrage between China onshore and China offshore for the sake of it. The investment decision is driven by fundamental bottom-up stock selection, and then naturally, we choose the option with the best price. We don't actively switch between A and H to exploit the valuation differential as a primary source of returns. As a result of our bottom-up stock picking approach, our selection in China A shares include a variety of stocks such as liquor, electronic manufacturing services, EV batteries, renewable electricity, and communication equipment manufacturers. This is the result of our active, pure bottom-up stock selection. Our portfolio tends to outperform in these following market conditions. First, steadily trending up or down markets. Second, periods of macroeconomic stability. And third, when company-specific factors are the main drivers of returns. Over the past 3 years, the Chinese equity markets faced the perfect storm. First, strong volatility and drawdowns. Second, weakness in real estate and consumption. And third, headwinds for growth names amid exogenous and domestic factors. Therefore, company-specific factors were not the key drivers of returns. However, when the Chinese equity market saw a rebound in performance, the fund tends to do well. During periods of growth recovery, JPM China tends to outperform quite significantly thanks to our high-quality growth tilt and long-term focus on fundamentals. Our team has not brought changes to the process, but rather an enhancement to the research input. The Greater China research team saw new appointments, David Gleason and Penny Tu, as the head and associate head of Greater China research. Major enhancements: more rigorous examination of PE research assumptions and framework at the industry level. Our team is putting additional thought into an industry framework, which is an additional tool to scrutinize the analyst forecasts, emphasizing industry-level analysis and insights. It helps to think about structural changes in an organized, systemic way, ensuring that the overarching industry outlook is achievable from a macro perspective, and captures any structural changes occurring in the industry whilst putting cyclical change in its appropriate context. Better integration with JP Morgan Asset Management China, or the AMC, to leverage their on-the-ground knowledge. The AMC team brings new investment ideas to our Greater China team and helps act as a sounding board for the team. New leadership of the Greater China Research Team in December 2023. David Gleason has taken over as the head of Greater China Research. Prior to his current role, David was the Director of Developed Asia-Pacific Market Research based in Tokyo. Penny Tu, Product Analyst for Greater China Equities, has taken on the role of Associate Director of Greater China Research. Penny reports to David and works closely with him to manage the team. Penny has taken the lead from a research perspective as we increase collaboration and integration with the AMC team. Three aspects stand out. We are the best resourced offshore Chinese equity manager in the industry, with our Greater China team with 24 investment professionals, combined with insights from over 20 onshore research professionals from JP Morgan Asset Management China, the AMC. We combine the best of an international organization with a large local footprint, with emerging markets and Asia-Pacific equities alone having over 100 investment professionals. We have enhanced depth of coverage mostly for onshore names, with more mid-small cap opportunities versus peers.